Welcome back to our weekly update. I'm Charlotte McLeod with investingnews.com, and I'm here to give you a quick look at our top stories for the week. The gold price broke the $2,000 per ounce mark again this week, drawing strength ahead of the Thanksgiving holiday in the US. The yellow metal is reportedly being buoyed by a weaker US dollar, which hit a 2.5-month low on November 21st. The release of the US Federal Reserve's latest meeting minutes did lend some support to the dollar after the release that same day. The summary shows that while officials continue to keep a close eye on inflation, they plan to proceed carefully. Most market watchers are not expecting further interest rate hikes during this cycle, and CME Group's FedWatch tool shows that a cut isn't widely expected until May 2024. The Fed has consistently reiterated its 2% inflation target, and last week's Consumer Price Index data shows prices were up 3.2% year-on-year in October, although they were unchanged month-on-month. Core CPI, which excludes food and energy, was up 4% from the year-ago period and 0.2% from September. The central bank's next meeting is set to run from December 12th to 13th. Gold isn't the only commodity that's been making moves this week. We, of course, also have to take a look at uranium, which continues to power higher. This week, the spot price passed $80 per pound for the first time since 2008. I recently heard from Ciampaglia of Sprott Asset Management, who said the uranium sector has entered its next phase, but is still early in the current cycle. He addressed a question that many people have, which is where the price goes from here. Uranium's short-lived spike to nearly $140 in the last bull market is well remembered by investors, but so far we've seen a fairly slow and steady rise. Here's what John had to say about what's coming for prices.
I think it's fair to say that we have been moving in this kind of staircase pattern since 2021. That's a very healthy, gradual rise in the price. Now, having said that, why people anchor onto this spike theory is because it is a very concentrated supply chain. You have one country that produces 45% of the world's uranium. It's like the equivalent of having a single country, like the equivalent power of OPEC. So it is a highly concentrated supply chain. When you add in all the other countries, such as Uzbekistan, and I was referring to Kazakhstan, but when you add in all the other countries like Uzbekistan and China and Russia, they control a pretty significant size of the overall global production. And then more recently, we've had a coup in Niger, which is another country that produces 4% of the world's uranium. And people, focus on this risk that if there's a disruption in any of those countries, you could have a short-term squeeze or a supply crunch, and that could cause the price to spike.
Stay tuned for the interview with John, which we'll be posting next week. And if you want to know more about the uranium landscape in the meantime, I recommend checking out our playlist from the New Orleans Investment Conference. It includes great conversations on uranium with experts like Rick Rule, Lobo Tigre, Gwen Preston, and more. I'll leave the link in the video description so you can take a look. That's all for this week. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.